Hi, this is Paramdeep, and in this session we'll speak about the cash flow statement. Cash flow statement is one of the most important statements in any company, right? And it gives you the real picture of the cash flowing in and out of the company. Please note that the profit and loss account and the balance sheet are on accrual principles. So my P&L and my balance sheet, right, they use the accrual principle. So for example, if we were to speak about this this concept of depreciation, so for example, in year one, I let's say bought an asset. So in year one, I bought an asset for let's say $1,000, right? And this asset is going to last me for 10 years. Is that okay? Its worth is going to be utilized for the next 10 years. So I have year 2, year 3, then I have year 4, and so on. I have year 10, right? So if we speak about the profit and loss account, right, we'll have a depreciation. So depreciation is an allocation of my cost. So I depreciate it like $100 each year, right? So this goes out of my revenue, and my profits are reduced by $100, right? And my asset value, my remaining asset value, so if we call this as the gross block, right, then my net block would be 900 out here, it would be 800 out here, 700 out here, and 0 after year 10, right? But in reality, my cash position, right, in reality, I really give out this cash of $1,000 in year one. I do not give out cash in the form of $100 each year. So if you are running a company and you are managing the cash of the company, your concern is that this $1,000 goes out in year one and not as $100 in all of these years. So sort of your P&L is a little smooth, right, because of the depreciation. So this is in the form of depreciation. Your P&L is a little smooth, right? So sort of your expense is like $100 each year, right? But a cash is very volatile in nature. So you have a sudden sort of spend of cash in year one, right? You have a sudden spend of cash in year one, whereas there is no cash outflow after year one. Whereas your P&L is sort of smoothened out, right? So as a company, as a management of the company, I am really concerned about the cash because that's where the sort of value lies, right? So the cash could be again this just to summarize it. The cash flow statements give the actual position of cash of the company. It's the ability to generate cash from the operating activities, and sort of this in real terms gives you the real picture of the business. So for example, how much are you selling, how much are you producing? So sort of this gives you a real picture of the business, right? Your investing activities could be your purchase of the fixed assets. So for example, if you're buying out some plant, or if you are investing in long term in one of your subsidiaries, and so on. And your financing activities essentially show how you are going to finance this investing activity, right? So the most important of these is your operating activity, right? So your operating activity, so your cash from operating activity essentially says how much are you going to be able to sell and in turn manufacture, right? So it really speaks about the profitability of the company, whether you will be able to operationalize your plans profitably or not. Obviously, to make these plans operational, you need investing activities, right? So you need investing activities. So investing activities could be in the form of buying new plant and machinery, or selling whatever is not useful to you, right? And obviously, to fund these investment activities, you need the financing activities. So financing activities essentially speak about how you are going to fund these investing activities, right? So it could be in the form of equity, or it could be in the form of debt, or it could be in the form of convertibles, right? So cash, whenever we speak about the cash flow statement, please note that this is on the cash basis. This is not on the accrual basis, it is on the cash basis. So actually what's flowing in and what's flowing out of the company, right? So if we were to sort of see what kind of operating activities could be there, so there could be a cash inflow in the form of revenues from sales, and there could be a cash outflow in the form of cost of production. So this is the simplest cash inflow and outflow possible. Obviously, if your inventory is increasing, so inventory is like current asset to you, right? So if there is an increase in inventory, so let's try to look at what does an increase in inventory mean. So if there is an increase in inventory, so for example, let's say in year 1, I had a total inventory, a total raw material inventory of, let's say, $100, right? In year 2, if I have an inventory of $200, right? So this is my inventory value. That means an additional $100 are locked in the business, right? So if the inventory levels were still $100, right? Then sort of you have no extra cash locked up in the business. But if it increases to $200, that means that $100 of your business are locked. Additional $100 of your business are locked, right? So you can't utilize these $100 as they are still lying with you in the form of inventory, right? So for that matter, any increase in a current asset or an asset, right, is like a cash outflow to you. So any increase in account receivable, inventory, account, any increase in your account, in your current account is like a cash outflow to you. Any decrease in a current account, in a current asset is like a cash inflow to you. So for example, if my inventory were to go down to $50, right, then this is like an additional $50 of cash available to me to be utilized in the business, right? Similarly, if there is an increase in account payable, so that means that sort of you have bought the inventory from your supplier, but you haven't still paid the bill. That's like an account payable. So obviously, sort of you have more cash with you, right? So this is like a cash inflow to you. And similarly, a decrease in accounts payable is like a cash outflow to you. Taxes paid are obviously cash outflow to you. So this is all from the operating activities. Please note that operating activities tell you the real sense of business, right? These are the most important part. Obviously, to run that, to manufacture those parts, you need plant and machinery. So any purchase of fixed assets or plant, or any purchase that you are making is like a cash outflow to you. Anything that you're selling off. So for example, if you had bought a plant for $1,000, right? If you bought a plant for $1,000, so I buy a plant for $1,000. So that's like $1,000 gone out of me, right? So this is like a cash outflow to me. But later on, if I sell this plant, let's say if my business is not doing so well for this particular sort of part, then I sell this plant for let's say $500. So then this is like a cash inflow to me, a $500 cash inflow to me, right? Similarly, if I'm disposing of any intangibles, or if I'm getting some interest, it's like an investing activity inflow to me. Now, obviously, financing activities, how do I get inflow? I could issue new equity, or I could borrow debt to increase my inflow. Similarly, if I'm repaying the debt, or I'm paying some dividend, that's in the form of a cash outflow from a financing activity. So just to summarize, cash is like the blood of the company, right? Without cash, no company can survive. So I have to sort of to categorize my cash. I am categorizing it in the form of operating activities, investing activities, and financing activities. So operating activities is sort of how is the business doing. Investing activities is to enable that business. I have to put up a plant and machinery, and financing activities, how am I financing this business through equity, debt, and so on. And correspondingly, you have a cash outflow. Obviously, the better the cash condition of the company, the better it's performing. Again, one thing that we would always notice, how is it performing operationally, right? So from the operations, how much cash is it able to generate? Another thing that we need to note, so for example, if we want to go from the balance sheet to the cash flow statement, the first thing that we would always note is that how much is the current asset increasing or decreasing. So if the current asset is increasing, it's like a cash outflow to you. If a current liability is increasing, it's like a cash inflow to you, right? So the first part where we would start sort of generating a cash flow statement. So when we start generating our cash flow statement, the basic principle that we would use is that increase in my current assets is like cash outflow, right? Whereas a decrease in current assets is like sort of let me use this one, is like a cash inflow, right? So if there is a decrease in current assets, it's good for the business, right? If there is a sort of cash outflow, then it is bad for the business, right? So similarly, if there's a current liability, if the liability is increasing, it's like a cash inflow to the business, right? And if it's decreasing, it's like cash outflow to the business. Similarly, as we discussed while discussing the P&L, the depreciation is not really a cash outflow. It's just an allocation of cost, right? So we would always add back the depreciation to our PAT to get the real cash generated from the operations of the business, right? So anything that is non-cash has to be sort of accounted for, right? So when we start creating a cash flow statement, we would definitely get a clearer idea of how to create a cash flow statement. Again, the cash flow statement can be generated by two methods. So let me tell you how to generate the cash flow statement. So cash flow statement can be generated by two methods. So my cash flow statement can be generated by two methods. One is called the direct method, right, and the other is called the indirect method. So in the direct method, I have a receipt of what cash is going out of the company. Usually this can be generated by the CFO of the company, right? So they would have the receipts of all the cash payments made, right? And all the cash inflows that are there. Typically, as an analyst, you would always use the indirect method, right? Where you don't have the cash, but you would generate the cash flow statement from the balance sheet and the income statement, right, or the P&L. So I will generate the my cash flow statement from the P&L and the balance sheet. The simplest method to do out here again is that you note your current assets. So an increase in current assets implies cash going down, and increase in current liability implies cash going up. Similarly, any increase in asset or liability, the things are going to remain the same. So from the P&L, what we would get is that PAT, or the retained earnings that are going into the company, are obviously like the cash inflow to me, and I add back the depreciation, right? I add the depreciation to it because it is a non-cash expense. So sort of we would start with this part, and then we would take care of the balance sheet part to get to a cash flow statement. So I do hope that you have found this tutorial to be useful, and do hope to see you in further tutorials. If you want to contact me, feel free to drop in an email to me on paramdeep@enev.com, right? Or you could give me a call on +91 9892 980608. Yeah. So I thank you all for being so patient. Thank you.